just the key concepts in building your business plan and financial model. So the fees charged to franchisees are key. So when you think about your fee structure, it's important to put a business plan together, and it's important to always have, a win-win scenario. You want to have a reasonable return, and so that both parties have a win-win area. Your price point to where you charge your fees for your franchises, you want to make sure are very reasonable for your franchisee. Royalty fees and your franchise fees are your main revenue sources. For franchise fees, you don't necessarily want your initial franchise fee that you charge to be a revenue generating fee. It really should be more of a cost recovery tool, and we'll go into that in a little bit more detail in a couple of slides. But generally, those fees are between $5,000 and $25,000. And then royalty fees, you want to make sure that we'll go into that in a future slide, but you want to make sure that your royalty fees are also something that both your franchisee can afford, but that also you don't want to understate what you can possibly charge to your franchisees. So for example, if you have a 1% understatement in what you could have charged in a royalty fee, and that resulted in $5,000 per year times 100 franchisees over 10 to 20 years could actually be kind of a $5 to $10 million loss in revenue. So you just want to make sure that you're taking a look at that when you're determining fees that you charge. These are just some common revenues that are generally charged by the franchisor to the franchisee. So again, the initial franchise fee that we talked about, and we'll talk about that a little bit more. Royalties, and then markups on products sold. So if you have products that you're selling to your franchisee, you can have markup on that product that you're selling. Advertising fees, so you provide advertising for your franchisee. That's a fee that's typically charged to the franchisee, and it's based upon sometimes a percentage of sales. Territory-based fees, so these are just area development fees, someone buying an entire region to have the right to open as many stores as they would like in that region as a territory-based fee, typically. Contract-based fees, these could be technology fees. If you're charging a technology fee for the use of an app, those types of things, that's a technology fee. And then fees for services provided or consulting fees. Maybe somebody is running their own business and they'll need some assistance. That just provides the franchisor an opportunity to generate more revenue to the franchisee. And then rebates from vendors. Instead of having 100 franchisees individually purchasing from the same supplier, you can have rebates where the volume purchases can be both a discounted price to the franchisee, and then the rebates that are can be the rebates provided based upon volume purchases can also be a revenue source for the franchisor. Real estate fees, these would be upfront fees and relate to site selection. The importance of the site selection process can make or break, the difference in how successful a franchisee is. And so assistance with the site selection is really important, and that real estate fee is just another fee that can be charged to the franchisees.
Let me talk about You do that instead? That's better? Okay.
Stay between the
Okay. Since I see the underbelly of franchisees, so I do all their accounting, so I see what they do. And one area that I think as a franchisor you need to be concerned about when you offer up these area development fees, hey, we'll give you, there's a region, this area, you got to be real careful, because I've seen many franchisees going into it thinking, okay, well, I can add another 20, 30 stores in this region. They have to have the resources to do so, and they're counting. A lot of them are counting on using the cash flow generated to be able to have those funds to do that. That doesn't always happen. So when you're looking at offering these area development to these franchisees, you want to see their balance sheet. You want to say, okay, how are you going to fund this, other than hopeful that the next 2 years of these existing 10 units are going to generate cash flow to give you the capital to do it. So I think be really careful when you do extend it, because once you extend that, then you have this group that's supposed to be 20 stores in the next 3 years. Your year 2, they've done nothing because they're not performing well. So I think you have to be really careful how you structure that. And I don't know if you hold back those development agreements over time, or maybe just kind of give them parameters that are more realistic. So that's one thing to be cautious of.
This slide just talks about just some important considerations to think about as you're determining your initial franchise fee. As I mentioned before, your franchise fee is really not a profit center. It's more of kind of a cost recovery tool, because really your revenue stream that's going to generate profit is going to come from your royalties that you receive from long-term and sustainable relationships that you have with your franchisees. But when you're thinking about your initial franchise fee, you're going to have some startup costs that you're going to have to recover, that you want to pass through in the form of that initial franchise fee. So it's important to consider some of these costs, such as marketing, sales commissions, legal, collateral, site selection, training, and travel. You also want to make sure that it doesn't create kind of a barrier to entry. You don't want it to be something that your potential franchisees are going to turn away from because the initial franchise fee is too high. So you really want to evaluate what you're charging as your initial franchise fee more from a cost recovery aspect than from a profit generating revenue source. And then on royalty fees, this is your most common revenue source. It's based upon a percentage of sales. The modeling is key. You do have some costs that are obviously going to have to be covered through royalty fees, that when you're modeling out what percentage of sales do I need to charge as in the form of a royalty fee, what are some of the costs that I need to make sure that I'm going to recover when I'm charging those fees or determining the percent. Some of those costs include hiring plans, salaries, any kind of franchisee support that you're providing that's incurring a cost, whether it be from your time or something else that's a cost on at the franchisor level. Franchisee cash flow models, target markets, and then just the speed of growth. So how fast do you want to grow franchisee locations? So if you're growing faster, you're going to want to incur more costs, such as sales and marketing. And are you going to be able to sustain that if you're not passing some of those costs through in the form of a royalty fee that you're charging to your franchisees? So strategy varies across concepts. Is it a low cost or high cost? And just an example here we typically see would be like 4% to maybe even up to 12% of sales that franchisors are charging as royalty fees. On the lower end, a food service franchise might be an example of a high volume franchise, and revenue is so much higher, and because of that, your royalty fee might be more on the lower end. Or relating to maybe charging 10 to 12% for your royalty fee, that might be if you're a consulting franchise, and because of that, you have a lower volume and then a higher percent fee on royalties. So all of these are just important considerations to think about when you're determining what do I need to charge in royalty fees, because again, it is a profit center for you. It is something that you want to make sure you're generating a profit.
So with that in mind, the franchisee's perspective is, what is the royalty fee based on? Gross sales, net sales? Over the last year and a half, the third-party delivery services have been really prominent, more than ever because of the COVID. And what we're seeing is, how do you determine the sales that are under the royalty? So if they have a third-party delivery and they're charging you 20%, and it allows you to market the price up by 15%. And then they charge us a fee. So how does an accountant know how to show that gross sales on your P&L, on your sales tax, and also your royalty calculation spreadsheet? So as a franchisor, you need to have that documentation in your agreement saying, how do we calculate the royalty gross sales? Because I can tell you from a franchisee perspective, I'm hearing, well, it's not very clear. I can deduct the fees because that's not what they meant. So you got to be really cautious of how you document what that fee is going to be calculated. So just heads up on that, and I would have dialogue with your franchisees to make sure they know, hey, this is how we're doing it among the agreement, in the agreement. So there's not, later on you go back and say, that's not what we agreed to. So just a heads up.
And then after you determine some of your more common fees and you've got your franchisees up and running, it's important to evaluate franchise performance.